Good morning, everyone. Welcome to the press conference.
In terms of global growth, is lower in this year, and this is due mainly to the headwinds from elevated cost pressure, high interest rate, and also weaker goods rates. But nonetheless, growth remains supported by our resilient domestic demand and also strong labor market conditions and continued improvements in global tourism activity. While China's reopening remains supportive of the global economy, its pace of recovery has slowed in recent months. We acknowledge that. Nevertheless, Malaysian economy is also well diversified in terms of product and trade partners. Therefore, that will also cushion in terms of the impact that's coming from China. And I should also clarify that we have been rather conservative in our forecast for China. And over the decades, I mentioned just now, we have deliberately developed a highly diversified economy and diversified trade partners. And this means we don't rely too much on one particular industry or one particular trade partner. China is our second largest export market. It only accounts for 13.6% of Malaysia's total exports. There are others that also counts higher. And also in terms of relating to what you highlighted with regard to the global economy and the risk to Malaysia, if you look in terms of our financial sector, they are also resilient. Banks are lending to households and businesses, and look at liquidity, it remains ample as well. And we have the means to manage the volatility we see in the financial markets as well. And lastly, another point that I need to highlight is that our external positions remain strong with our current account surplus and also adequate international reserves. These factors, together with the flexible exchange rate, will support our ability to weather the external shocks that may hit the economy. With regard to the questions on Manisa Bloomberg on the GDP figure bottoming in Q2, how soon will we see recovery? I think GDP growth in the second half of 2023 would have to average between to 3.7% to achieve the 4% lower bound growth for 2023. Going forward, we see growth is expected to continue to be driven by expansion in domestic demand amid weaknesses in the external demand. This will be supported by a few factors, Nisa. One is in terms of the continued improvement in labour market conditions that we are seeing, continued progress of multi-year investment projects by both the private and public sector. As I mentioned just now, the higher tourism activity will also further help us in terms of the recovery with regard to not just tourist arrivals, but also in terms of travel receipts towards the pre-pandemic levels. And if you look at the supply side, the growth will continue to be driven by the services and construction sectors.